people actually forget that might be new in the market. You used to be able to get a 40-year amortization and 0% down as an insured mortgage about 15, 18 years ago. They lowered it to 35, then to 30, and then to 25, and obviously increased the amount of down payment requirement. Now they've increased that to that 30-year. On average, for the average home price in Ottawa of $620 or $20,000 rather, roughly, it's going to mean if extending that amortization to 30 years is going to save somebody on their monthly payments about $300 a month.
Welcome to the Ottawa Real Estate Podcast. Join your hosts, Paul Stevenson, David Warren, and Greg Campbell, as they explore the world of real estate and mortgages. From the heart of Canada's capital to markets nationwide, and even a little beyond. Get ready for expert insights and hot topics. Let's get started.
Yay. Wow. Oh, we are back. It's the Ottawa Real Estate Podcast. I'm firing up Greg after that friggin' jingle. Let's go. I like to make jingles. I like to do it.
We're going to have to change your name to the
Big Jingler.
From the Big Stuff.
Jingler. I like it. Big Jingle. Welcome, everyone. My name is Paul Stevenson. I'm a level 2 mortgage agent, and I'm joined as always by Greg Campbell, a partner at the Campbell Merrick Group at eXp Realty, and David Warren, mortgage agent level 2 and owner at Referral Mortgages. Gentlemen, how are we doing? What's going on?
What's shaking?
So much. Yes. A lot has happened since last week. A lot of hate, a lot of love.
Yeah, I think a lot of people were happy for us to be back, and I think a lot of people were just waiting for us to come back so they could make shit comments about us.
It's great.
Oh,
so funny.
For anyone who listens and doesn't watch, we have a few, you could say, haters on YouTube. Most of all, just that they think that we're constantly pumping the market. And what's hilarious is last week we literally showed charts of actual statistics. Like we're not pumping anything. We're literally showing numbers and giving our opinion of Ottawa. Still pumping the market.
Yeah. Yeah.
Haters gonna hate.
Hey, they make comments about, some of the other podcasts that do more of a macro take on things based on the Vancouver and Toronto markets, right? Where it's a completely different scene. Not to say that things aren't changing here, but it's a different beast. Anyways, Ottawa Real Estate Podcast, where we talk about Ottawa real estate primarily. Right, guys?
Yes, sir. Lots of changes. And David, welcome back. We missed you.
Thank you, sir.
The return.
I know.
Looks like you're looking healthy, sharp.
I'm still getting over this cold. Last week I could barely talk. I watched you guys record, did not partake because I sounded like absolute crap, but good to be back, gentlemen. Good to be back. And it's a busy episode to be back too.
Yeah.
Lots going on this past week.
There's been a lot of talk.
Lots of change.
A lot of talk.
Yeah.
There has been.
Well, why don't we just let's get into the news.
Get into it.
Oh, and we're back with David Warren.
And we're back.
Holy smokes. I'm sure everyone listening has heard or read about the changes that the finance minister released yesterday, coming into effect for December 15th, which is coming some good changes, some Band-Aid changes, so it'll be interesting to see how people react to it. And I know some colleagues have reacted in a 50-50 fashion, but they've eased rules for first-time homebuyers. So as of December 15th, first-time homebuyers are going to be able to not only purchase a property with less than 20% down up to $1.5 million. This really only pertains to Toronto and Vancouver markets. Obviously, that's a very high price tag, but the average home in Toronto being over $1 million, that's obviously going to help. But, a lot of people are saying, obviously, to get to that price point, most people are going to need 5 and 6 people on the mortgage from a co-signer perspective. So it's, not really going to affect much there. But one thing that is a nice change that they implemented for the end of August was for extended amortizations up to 30 years for first-time home buyers. End of August was for just new builds. However, they changed that as of yesterday, starting December 15th, that first-time home buyers buying resale or new builds will be able to have an amortization up to 30 years. This is great news. I think this was the case years ago. And people actually forget that might be new in the market. You used to be able to get a 40-year amortization and 0% down as an insured mortgage about 15, 18 years ago. They lowered it to 35, then to 30, and then to 25, and obviously increased the amount of down payment requirement. Now they've increased that to that 30-year. On average, for the average home price in Ottawa of $620 or $20,000 rather, roughly, it's going to mean if extending that amortization to 30 years is going to save somebody on their monthly payments about $300 a month. So, for this first-time home buyer, is going to help them with obviously their monthly cash flow and budget, but allow them to qualify for more. So it's going to be like it's a pro and a con, being that it's going to, for as long as prices don't increase, then that's great, because it's going to allow them that option to lower their monthly obligation, still having that option to increase their payment if they want to pay it off quicker, but at least from a initial standpoint, play with that. However, it is allowing people to qualify for a higher loan amount, meaning that it's seemingly going to obviously bump those prices up if, people are qualifying for higher amounts. So it's, it is, some of that is a little bit of a Band-Aid on the solution, on the issue, being that it's not helping the housing starts or the supply. And housing starts I think they were down at a decade or 2-decade low last month, if I'm not mistaken. So, that's obviously, it is seemingly good news, but then at the same time is also not addressing the primary issue, really.
Yeah, I think when they came out with the 30-year AMs for new builds, it was only a matter of time before they kind of carried that over to all first-time buyers. I think for, as you said, like the pros are obviously improved accessibility, especially in high-cost markets like in Toronto and Vancouver. I think the lower monthly payment, I think for a majority of people, is actually really good. Now, the cons of that are also, it's definitely going to increase housing demand and price growth if people qualify for more. Typically, at least from my experience, I'm sure yours too, Dave, most people, if they are pre-approved for 800 instead of 700, are going to be buying closer to 800. So knowing that, if that's 90% of buyers, then that's definitely going to drive prices up. The other thing too is, by going with a 30-year amortization over 25 years, I think the increased amount of interest is about 28%. You pay 28% more interest by having a 30-year amortization over a 25-year AM. So the long-term interest costs are much higher. Now, if that's the difference between getting into a home and not, then it might be worth it long-term with appreciation and pay down and so on. But just, it's inevitable that you have a longer amortization, you're going to have more interest costs. And then there's also the potential for people over leveraging. If you're buying if you couldn't afford a $1 million home and now you can buy 1.5 with 10% down, that's a huge loan to be taking on. You're talking about, $6,000, $7,000 a month in a mortgage payment. Most first-time home buyers are not getting there. But again, in Toronto, if you're a first-time buyer and maybe you're buying with 2-3, family members or what have you, and you're all going to be living together in that home, then it makes it a little more feasible. You're buying $300,000-$500,000 homes as opposed to $1.5 million home, to break it down. But yeah, it'll be interesting to see how it shakes out. This doesn't take effect till December of this year. So I think leading into the spring market, it'll be interesting to see how those pre-approvals look for first-time buyers. And Dave and I will have a firsthand experience dealing with those first-time buyers and kind of having those conversations. But I think overall, I think it is positive. I think just making things mildly more affordable is going to be beneficial for a lot of Canadians. And I wouldn't be surprised if we do see this potentially, if it's a success and it doesn't explode the pricing market. I think we may see it expand even further, or potentially to all buyers. But first-time home buyers are still, a smaller subsect of the market. I would assume maybe, 15% of people are first-time buyers. That's just a complete guess. I don't have any statistics. It's just but if it's 15%, they're not going to necessarily massively impact the market by having increased affordability. But who knows? It might bring more first-time buyers to the market. So we'll have to wait and see.
Are these mortgages with the 30-year amortization, are they specifically 5-year terms, or can you do a 2-year, 30-year amortization?
No, they'll be on any term. So 1, 2, 3, 4, 5, 7, 10, variable, fixed.
Is it big? Sorry, it would make sense to me, as a first-time buyer, to just, if you need to get to use that platform to get in, maybe get a 2-year and then readjust later, especially if the rates come down a little bit more, and then adjust to like a 20 or 25 if you can. I would get the 3% or 30-year and then pay it as if you're paying a 20-year or a 25, if possible. You know what I mean? That's the perfect world, right? So you're paying down the principal. But yeah, I was just curious because I mean, to help get in, I remember I did a 30-year on my first property, and it really helped. And then I changed back to a 25 after, and it was fine. I just kept paying the same, or I was just an increase, but it didn't matter. I was fine with that at the time. My equity was gone up too. Anyways.
Yeah, I think from looking at that 30-year AM for a first-time home buyer, people say, like Paul mentioned, a 28% increase in interest costs. Somebody could take a 30-year amortization as a first-time home buyer so that their minimum monthly obligation or their monthly obligation is as low as possible, but voluntarily increase their payment as if, just what you said, as if they're on a 25-year. What that allows them to do is if they go through a rough patch, maybe they change jobs, maybe somebody loses a job, maybe they, some sort of, maybe they have a child and they, they're a first-time home buyer, single, then they get a partner and they have a child. That's a big life change. Having that lower monthly obligation is going to be beneficial. So in the time they have the room, they could make those increased payments voluntarily and then drop it back down if something happens with their life. Obviously the past 4 years has shown us that anything can happen. So having those kind of backup strategies or plans, to be able to drop back down if something changes is going to be beneficial, I think. But I do think, in my opinion, it's not addressing the housing supply issue, which is going to, so it's until that is there from a buyer perspective. I also think they need to address making it cheaper for a first-time home buyer. Like, land, I know I think it's Alberta, they waive the land transfer tax completely. Right now in Ontario, we have a $4,000 credit or rebate, but like wipe it out completely. Why have that as a barrier for that added savings for a first-time home buyer? Like make it remove the actual cost to entry for a first-time home buyer. And it's only for your first home. It's not for because you got separated and buying another one, or because of this, or you sold and rented for 4 years, because there are those caveats in some of the first-time home buyers programs where they reset. But I think on that very first home, lower that cost barrier to entry of that hard dollar up front.
Yeah, the $368,000 cap for the land transfer tax, that came out probably 7 years ago. Mm-hmm. And at the time, that was kind of the average home price in Ottawa was like $400 to $450. So it made sense, right? It almost covered every purchase. Now that 368, literally almost every single first-time home buyer is paying some land transfer tax because there's very few homes that are under that 368. The other thing I was going to say is I feel like this also, although it seems like big news today, we could also see this have very little impact on the market. Like I know when the 30-year amortization came out for new builds, it was kind of like that first rate drop. It really was a buzz for a week, and haven't had a single conversation about it in 3 months, 4 months. So it'll be interesting to see what conversations come of this, I guess. And that's why I was saying, going over the winter, people prepping for the spring, I think that's when we're going to have the majority of these conversations. And I think just letting first-time home buyers know, most of them probably won't know when they come to us that this is possible. So having that conversation with them that this is available, this is possible, I think will probably potentially excite them, just knowing that they have that lower payment, but also making sure that they're aware of the, as we said, the potential pitfalls or risks as well associated with the longer amortization.
I feel like every year we do this show, we always talk about these amazing things that the Canadian government implements, and then 12 months later, we talk about how no one gave a shit and no one used.
I think the 30-year AM people will use. I think that will be very common
across the board. For sure.
The 1.5 limit is there's very few people, and all I can read online is who the hell is qualifying for $1.5 million property or over $1 million. But being, from the outset, we're talking about, Ottawa real estate. Yeah. It's not uncommon for, and I see it with applications at clients, it's not uncommon for 2 government salaried workers making 100 plus each, or 1 high tech and 1 government, and combined income of 250 kind of thing, which you're qualifying for more than $1 million, or one, or even just one individual with one of the high tech firms like a Shopify or whatever it may be, are over that 200,000 as an income. That's not that uncommon in Ottawa, and that's why we also have one of the highest median household incomes in Canada. So I think it will, it does give those people on that upper threshold that ability that, they're maybe not striving for that $1.5 million, because there's not a lot in that range anyways within Ottawa, but somewhere, it is just that slightly higher than $1 million gives them that little bit of flexibility, which, as we've seen detached homes in a lot of areas, just for your regular detached homes, are pushing that million mark, or were, and now they've come back down, but not to say that they won't very shortly.
What they should have done, and what they probably will do in the future, is like for CMHC and Sagen Canada Guarantee to actually insure all, like any mortgage, like just for insurable mortgages to be up to 1.5 million, because that cap of $1 million is still kind of ludicrous. If it's not your first home, maybe you're an established homeowner, but you want to buy a place that's, like you said, 1.2. Well, you can't have it insured. You need at least 20% down at that point. So I think that's just kind of like a feeder into that. I think it's kind of like just a nice soft landing for them to kind of see what the market dictates in that regard. But I do think that we probably will see CMHC and Sagen kind of extend their overall capacity to 1.5 million for all purchases, but we'll see. I think this is kind of like a test run to see how it impacts things. But with the default so low, I think last time we said it was at 0.28. Like, I don't see there being an abundance of risk to extending that insurable mortgage from $1 million to $1.5 million.
Yeah. Now combine those changes yesterday to news out this morning. We're recording Tuesday morning. Inflation numbers just came out for Canada from StatsCan, beating market consensus at 2%. We were 2.5 in July, and then dropped to 2, and the market was expecting a 2.1, I believe it was, for consent. Yeah, previous in July was 2.5. People were expecting a 2.1 for August. We actually hit 2%, which is right in line with what the Bank of Canada is looking for, and that's even with our prime and policy rate being so high. This past weekend, there was an article in Reuters from a presentation from the Bank of Canada Governor, Tiff Macklem, talking about he's opened the door for stepping up the pace of interest rate cuts. So we've already had 3 consecutive drops of a quarter point. We have an announcement end of October, I think it's the 23rd, and then middle of December. I won't be surprised with inflation come down to 2% if we get a 0.5% drop in there, and or it'll be consecutive quarter points, but I wouldn't be surprised if the October one, if inflation stays down through September as well, is a 0.5 point. But that'll be, time will tell on that, obviously. But I think with today's inflationary numbers, I mean, this conversation or presentation from Tiff Macklem over the weekend was prior to StatsCan releasing these numbers. So if he was already talking about stepping up the pace of interest rate cuts, I think today's news beating market expectations, et cetera, and being right at that 2% mark, I think will almost assure us of those quicker pace drops.
Should we get into the rates? Since we're right here, right on the edge.
What
rates?
Wow.
Let's just get into it. Yeah, so latest rate. So I think, there it is. Stephen's on it. 5-year government bond. Oh, we're looking at a 6-month chart here. If you're listening, you can check this out on YouTube, but showing 2.659. And this typically is a very strong reflection of where fixed rates are heading. I wouldn't be surprised, just given, especially with what you just said, Dave, I wouldn't be surprised if we see, a 3.99 fixed potentially by the end of the year, but I would say for sure leading into next year. I think fixed rates are going to keep dropping, maybe not as aggressively as that 0.4, but I do think that there's going to be one lender that comes out with some form of promotional rate. BMO is usually pretty good at throwing out those promo rates leading into the spring. So I would say probably, latest January, February, I'm going to predict, and, I'm sure our listeners will hold me to this if I'm wrong, but I'm going to predict we'll see, a 3.99 fixed in the next 3 to 4 months.
I think it'll be well before that. I think it'll be
there you go.
1 to 2.
There you go.
I think tomorrow, well, I guess when this comes out, we got Wednesday, the 18th, is the U.S. Federal Reserve making their policy rate decision, and there's expectation they're going to drop 0.5%. If they make a 0.5% drop, that directly affects our 5-year government bonds, because that decision affects the 10-year Treasury T-bill, and the T-bill and the 5-year Canadian government bond kind of trade in unison. So when that comes out from the States, I think that will push our bonds even further down. And I think we're going to continue that trend, especially with inflationary numbers and things like that coming out, and that expectation of an end of October drop. So I wouldn't be surprised if by mid-November we're seeing end of October, mid-November, that 3 in front.
That's a pump market.
That's wild. Yeah. I mean, I guess, the government's got to save the banks here.
Yeah.
The Bank of Canada has to save the banks. I don't know what else to say here. They just, the renewal is coming up next year, right? That's why this is happening.
Yeah. I mean, there's certainly unemployment rate is jumped up dramatically. I think we're at high sixes right now, I think nationally. So obviously businesses aren't investing or hiring, they need to drop. The only lever that the Bank of Canada has to help the economy is their policy decision which affects bank prime. So it's really the only lever they have we're one of the only levers, I should say. But yeah, it'd be interesting to see how it affects the market. I mean, who knows? To Paul's point before, some of this news comes out, it didn't affect anything, but obviously rates are what is going to, what's going to drive the market, going to get people back in, or what they qualify for, or what they can just stomach or can afford.
And let's not kid ourselves either. Like, the economy has certainly been propped up over the last couple of years. Like, most Canadians are certainly having a tougher go now than they were 2-3 years ago. A lot of, cost of everything's up, obviously. And I just think in general that the economy is much worse than they're suggesting it is. And I think this is a true reflection of that, right? Is seeing, like you said, the unemployment numbers now kind of balancing out, not being propped up by an abundance of part-time government positions that were keeping those kind of unemployment numbers low. I think now we're starting to see the trickle effect of the true economic factors, and they're much worse than what people were expecting. So I think we're going to keep seeing this trend going down. And for any of my clients who are listening, I will 100% continue monitoring rates, and I will get the float downs. That's always, anytime there's any sort of rate conversation, I'm getting emails. Have the rates dropped? Are you keeping an eye on things? Like, I check every morning. I make sure that I talk to my lenders. We get the rates dropped as soon as they drop. We're there. It's like New Year's Eve every morning here.
Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Galtin Poirier Avocat Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at galtinpoirierlaw.ca. Let's get to the heart of your deal.
Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca.
Okay. You want to get into some statistics here now?
Stats.
Let's
do it.
Greg.
Number us.
Stats.
I think we need like a musical note for each of those slides now. It was that news thing was so exciting. Next time, we'll get that in there. Something stats like ding, 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 ding. Like, I don't know. And the rates can be like, money chinging. What do we have up here first? We've got the residential average price. So this is just to show people what's going on across Canada. This is August 2024 versus August 2023. I mean, when you look at this, it doesn't look that bad. Everything is up except for Ontario and BC. And of course, most of the news that we see in Canada that people talk about on YouTube, but the market tanking, it's in BC and Ontario because a lot of it's been overvalued for years and it just not sustainable. So now it's correcting itself. In terms of all the other provinces, they're up since last year. Last year was pretty quiet, so it's also not that hard to be up as much as you were last year. But anyways, I just thought it was important for people on our show to see these things for all the viewers, I suppose. This is basic stats that we get from CREA at any time. You can also access these stats.
The Alberta and Newfoundland being up 11% and basically 10% in Newfoundland. I knew Alberta was booming, but Newfoundland and New Brunswick are jacked right up.
Yeah.
They're on a tear.
I mean, even Prince Edward Island's got some moves going on there.
Yeah. Probably relocations from Ontario and BC.
Next up, what do we have? This is the seasonally adjusted monthly home sales, the 10-year monthly moving average. So if you look at the far end, that's January 2024. I mean, I'd like to see that, next year for sure. But it's pretty much straight across back to basically 10 years ago. We're at the same amount of monthly home sales in Canada, which is very interesting. You'd think that number would be up based on new home starts or whatever, but it's not. Everything's just sitting. And whether that goes up or down, I think for the rest of 2024, like going into January, that's definitely going to be a downward trend, which could bring us closer to the 2010 even.
No, I guess this is home sales. So
this is home sales.
Has been there, especially this year, we see it in Ottawa. There's a huge push towards rentals. The incentive is for building purpose-built rental units. Mm-hmm. So the unfortunate thing, as you said, a 10-year average, we shouldn't be at that if our population has grown so dramatically, right? Especially in Ontario and in Ottawa. I mean, I don't know what our stats are in Ottawa from a growth over the last 10 years, but I would think we've added probably 15 or 20%. Obviously, we'll have to double check that number. But if we're up 150,000 people in Ottawa, or and Ontario is millions, it's kind of interesting that 10-year sales average would be basically in line.
Yeah, and that's the thing. It's a lot of people just don't see it. And here's the next one we got here is a residential market balance. Months of inventory, sales to new listings ratio. So again, we're back. I mean, and I compare the market a lot to 2019 in a way, not necessarily on price, but just on activity. Yeah. So, I mean, you can see 2019 January was a little bit higher than what it is now, but I mean, the sales to new listing ratio is the same. It's almost identical, right? Mm-hmm. Right around 50%. And that's July, right? So that goes back July 2019 was even higher sales to new listing ratio. Mm-hmm. So I don't know, man. This is this is Canada stuff, and it's good to pay attention to it. But again, we are the Ottawa Real Estate Podcast. I just felt it was important to start throwing some of this stuff in, as a lot of our viewers seem to want some of that information. I know that John Flynn shares this stuff all the time, and I'm definitely not trying to be a John Flynn. That guy is a data wizard, but just doing my part here. I did another little thing on Barrhaven. For those of you living in Barrhaven, this is interesting. I was working on this. I wanted to do something different, and this is only townhomes in Barrhaven between 2019 and 2024 in the last 4 weeks. So it would be to the middle of August, right? That's how I kind of like to do this stuff year over year. So if we just go number of sold listings, 2019 we had 10, 2020 27, 2021 13, 2022 15, 2023 we only had 2, 2024 we had 12. So the big year was the 2020, obviously. The rest pretty balanced. Now I've got median price in here. I like to work in averages, so I'm going to go over that one. Average list price in 2019 was $398,000. 2020, $465,000. 2021, $536,000. 2022, $614,000. 2023 back down to $552,000. In 2024, we're up to $605,000. So 2022 and 2024 are pretty close for the last 4 weeks in terms of your average list price. Now, the average sold price, let's just focus on 2022 and 2024 for a minute. 2022 is average list price and average sold price. 2022, the average price was $614,000. The average sale price was $607,000. And 2024 was $605,000 and then $587,000. So you can see that in those years specifically, well, I mean, actually, in one other one here in 2023, people were listing higher, selling for less, as opposed to going for way over. Like in 2020, we've got $465,000 as the list price, and the average sold price was $502,000. Same thing in 2021, you were up about $20,000. The average. 2019 was up too, creeping into the beginning of the change of things. Days on market, 2019 was 6. 2020, 7 days on market. 2021, 18 days on market. 2022, 16 days on market. 2023, 34 days on market. 2024, 26 days on market. This number is interesting to me because I think the 26 days on market for townhomes in Barrhaven, with what I'm seeing now, based on the amount of listings and the lack of sales, I think that's going to hit 35 to 40 in the next 4 weeks, unless things change really quickly. And then at the bottom, you've got minimum days on market. These are always the ones. There's always ones that come on one sell in 1 day. 2019, 1, 2021, 2021, 0 days on market was the minimum. I wonder what that's all about. 1 day on market, 2022, and then 2023, 29 days was the minimum days on market for a townhome. That's insane. Last August, September, October were just brutal. And then now we're, 2 days for the least, maximum days on market, 87. You've got an average days on market of about, I'd say around 50 over the last 5 years. All things considered for the maximum days on market. But I thought this was a good chart to look at. And again, this is only townhomes in Barrhaven, but the numbers, they've gone up 400 to 465, 535, 620, 552, and then down to 552 last year, and then back up to 605, pretty much, in terms of what people are listing at. So people are still looking to get top dollar, but it's taken longer to sell. And now with more competition coming out, it's going to be really challenging. So if you're selling, you need to be very well informed about what's going on, and you have to be super strategic, more so than ever. Everyone I'm working with, I have calls to make today because we're on almost 10 days on some listings and we're not sold. And in most of those neighborhoods where we have properties for sale, there's been 6 to 10 new listings coming out in the last week that are direct competition. And that's a very big challenge. So depending on urgency, like if you're a seller, you need to just adjust that right away. So I'm getting on the phones today. I'm calling all the agents that have new townhomes listed where I'm working with my clients, and I'm just going to see what they're seeing and what they think about this. I'll recap that next week because it's good to know. But if you're a buyer, of course, like you guys have options now, so just negotiate.
Great chart. I like that.
Yeah, great info.
Yeah, I think I'll get better at these stat descriptions as we move along here. More summarized, right, guys? I'll summarize the chart and it'll be great. Okay, my definition. Bring in that slide. There we go. My definition. I've got the definition this week. Seems to be Greg time at the end here. My definition for the week is an exclusive listing. So for those who don't know, an exclusive listing in real estate is a contract under which a property seller grants the exclusive right to sell the property to a single real estate brokerage. I mean, that's common in Ontario and most places in Canada. Unlike an MLS, multiple listing service listing, which is shared among numerous brokers, which are part of the network, an exclusive listing is not advertised within the MLS system. And as such, only the brokerage holding the listed is entitled to represent the property and promote it to an exclusive network. So some characteristics of an exclusive listing: privacy. Sellers who prefer not to have their property widely advertised often opt for an exclusive listing. It can be due to various reasons, such as high-profile clients, a desire for discretion, or simply to limit the number of people who know the property is on the market or come through the house. Controlled access. This is an interesting one, since, when you hold the property of an exclusive listing, when you hold the listing of an exclusive property for sale, you can market that to your own network, basically. So some of us in town have private networks of people who work in this way, and we try to share it to those people immediately. And what can happen is if you're marketing your home at a certain price point, you're doing this before you go on MLS, hoping that you don't have to. If anyone comes through the home, they're pretty much going to pay or offer you close to that listing price because they're paying the premium to have exclusive access to that property. So you have the potential for a higher sales price, paying for listing at that exclusivity. Potential drawbacks is listing exposure. The main drawback is that having an exclusive listing can limit exposure compared to the MLS because you're going to see everyone nationally and internationally is going to see it. Some suitable scenarios for an exclusive listing is high-profile celebrity homes where privacy is top priority, or just, people who want to keep to themselves. Unique properties that require specialized marketing or a specific buyer pool, and situations where the seller has a strong relationship with a particular realtor or brokerage that they trust explicitly. Overall, while exclusive listings offer certain advantages like privacy and dedicated service, they may not suit every seller due to potential limitations on market exposure and buyer reach. Crucial for sellers to weigh these factors based on specific circumstances and real estate goals.
I was actually going to ask you when you were showing the market stats and there's those 0 days, 1 days, 2 days, wondering if those are kind of exclusive or private listings where people, they knew who the buyer was going to be, posted it, sold it. I know there's a few in town here. I was speaking with a local realtor and he said that there was one property that came up about $100,000 under the market value. They had 28 showings booked. And after the first showing, they got an offer and accepted it. Like clearly, I talked about this, I think, on the show a few months ago, but that sort of thing where, you know, it's sold for well under asking. They had a lot of interest. They had a lot of people wanting to see it. And then they said, nope. So clearly there was something going on there. There was more of that story, you know.
It happens. It happens. You know, you call somebody, you know, it's almost like an exclusive, but you put it on MLS to get the stat.
Yeah. Or they're just needing to, they don't want the stress that many people through.
Yeah,
and they just need it. And they just need it sold because they already have a purchase that they're going for.
Yeah.
I find a lot of the, you know, talking about exclusive listings, I find a lot of the people that are doing those as well are an older demographic. So, you know, looking at downsizing, or they've been in their house for, you know, many years, and they obviously keeping up with the cleanings or having to be out of the house is kind of a pain. To always have that. So kind of wanting to go the exclusive route so that they're not having as many people through or inquiring about it, and they just want it gone with as little hassle as possible.
Yeah, it's interesting. I like exclusive listings, but what I'm finding now is that the groups they're accessible, but it's not the same buyer pool anymore. It used to be like you could go and talk to agents and they would sometimes have a buyer, but now because there's so many different agents out, when you're listed on MLS, you're going to see these people that aren't invited into these private networks sometimes, and they have buyers, right? There's a big change in the demographic of realtors in Ottawa as well.
Love it.
Well, should we get into the mood boosts?
I am ready to boost your mood. I have 3 today.
Let's do it.
Here we go. Number 1, do mascara and lipstick ever argue? Sure, but then they make up. Make up, yes. Say. Number 2, what do sea monsters eat? Fish and chips. Fish and chips. And last but not least, number 3, where do you take someone who's been injured in a peekaboo accident? The ICU.
Oh, man.
Wow.
Oh, man.
Wow.
That was amazing.
Yes, sir.
God, I want to be a part of the think tank that just comes up with all these jokes.
Oh, man.
The think tank.
Oh, that's called a Friday night at the Stevenson residence, basically.
Yeah.
A lot of dad jokes flying around. Thank you, everyone, for tuning in and listening, watching, whatever you're doing. Thank you for being here with us. We will be back. We are back every Wednesday, 10 a.m., new episodes. And make sure to follow us on all our socials where we have exclusive content and shorts from this episode. So if you don't want to listen to the whole thing, we get it. We'll give you little snippets just so you can stay informed.
Yes.
Thank you. We'll see you next week, everyone.
All right. Bye.
Have a good day, guys.
Deuces.